Hey friends, Irene here. After the G7 conference, that nasty revenge tax Trump tried to sneak into his one big beautiful bill, officially called Section 899, has been dropped.
I don't know why, I don't know who did it, but frankly speaking, it's a little messed up.
If you're an investor like me holding US shares, that's a great news. In this video, I want to talk about what actually happened and why you still need to be on top of the foreign income tax when you get those juicy US dividends. And if you hold ETFs like IVV, VGS, or VTS, how the foreign income tax offset works, and whether you can fully claim it back based on your tax bracket. Before the bill was passed, I explained in another video why this revenge tax was included and why Australia would have been labeled as a discretionary foreign country. And Section 899 would have imposed an additional 5% in the first year and another 5% in the second year. Therefore, your usual 15% US dividend withholding rate could have increased ultimately to 35%. This would have dramatically reduced returns for Australian investors. And Australian super funds are heavily invested in US companies too. So you can imagine governments and investors worldwide freaked out. Australia's super funds lobbied hard.
The Treasurer has lobbied his US counterpart to address a so-called revenge tax that could smash Australian super funds and investors.
And there's this aspect within it that does concern very significantly Australian investors, business and shareholders. So much so that Treasurer Jim Chalmers had this phone call today with the US Treasury Secretary Scott Bessent.
And treasuries from other G7 nations pushed back. On June 27, 2025, US Treasury Secretary cut a deal with the G7. They would exempt American companies from the OECD Pillar 2 global minimum tax, and in return, Section 899 was pulled from the bill at Congress' request. So no actual revenge tax, and we're back to the tried and true US-Australia treaty rates. And Australia and the US have a long-standing tax treaty that reduces the default tax rates, which is 30% on cross-border investment income. Thanks to our tax treaty, the rate drops to 15% if you file the WA BAN form with your broker as an individual investor or the WA BAN E for a business account. Any interest is taxed at 0% under the treaty, although you might see 10% on some bonds. Capital gains on US stocks, generally nothing, unless you are in special categories such as real estate. With Section 899 off the table, those treaty rates remain in effect. But that's only half the story from the US tax point of view. We need to look at how Australia taxes the same income and how you can avoid being taxed twice. First of all, if you're an Australian resident for tax purposes, your worldwide income is subject to Australian tax law. To prevent you from paying twice, you receive the foreign income tax offset, FITO. For example, if Sarah gets $100 in dividends from her Apple shares, $15 will be withheld by the US government and leaving $85 in her bank account. Sarah needs to declare the full gross foreign income, which is $100. The ATO calculates tax on those 100 dividends. Say she's in 30% tax bracket, therefore that's $30 in tax to the ATO. Then she can claim the $15 US foreign tax, and she would only need to pay $15 to ATO. In the end, Sarah gets $100 minus $15 US tax and $15 Australian tax, which equals $70 net in her pocket. She has paid exactly a 30% rate, which is her tax bracket. No double dipping. Is that it? Wait. Sarah's tax bracket, based on how FITO works, can help her avoid paying double taxes, but does it eliminate the extra tax for your tax bracket? Whether the foreign tax offset completely covers the 15% US tax or not depends on two things. Number one is your Australian tax bracket. Essentially, the higher your Aussie tax rate, the more of that 15% credit you can claim back. Number two, your foreign tax paid is less than $1,000. So let's talk about the marginal tax rate first. Here are the current marginal tax rates for Australian residents, 25-26 financial year, excluding the 2% Medicare levy. This is a progressive tax system. For example, if Sarah falls into this 30% bracket where her wage is $80K and any additional income such as investment dividends will be taxed at this 30% rate. However, the overall tax only takes 19.1% of her income because her first $18,200 doesn't need to pay tax and $18,200 to $45K pays 16%. All right, that's a side note, and let's come back to the FITO. Most working Australians fall somewhere in the middle of these brackets, and let's run through 5 different scenarios. Everyone gets a gross US dividends of X dollar. Uncle Sam takes his 15% cut first, then Australia steps in with FITO to avoid double taxation. Here's what happens. Alex doesn't need to pay any Australian income tax, so he doesn't have any Aussie tax to offset. Based on ATO's foreign income tax offset rules, once your tax payable has been reduced to 0, any unused foreign income tax offset is not refunded to you and cannot be carried forward to later income years. As a result, Alex loses 15% to the US and walks away with 85% of the dividend. And Bob's marginal tax rate is 16%. His total tax is split 15% to the US and 1% to the ATO. Exactly his marginal tax rate. His net dividend is 84% of the dividend. Kathy, Damien, and Ethan would all fully absorb the US without tax, but they all pay more tax to the ATO due to their higher marginal tax rates. So let's recap. If your Australian marginal tax rate is less than 15%, you're stuck paying the full 15% US tax because FITO cannot create a refund. And this doesn't mean investing overseas is a bad idea for low-income earners, but it does mean the 15% foreign tax can eat into your returns more if you otherwise wouldn't be taxed much at home. On the other hand, you can always invest in foreign growth shares or ETFs instead of income-focused investments. The good thing about that is that Australian tax residents generally do not pay US tax on capital gains from selling US shares. FITO works best for those in at least the 15% plus tax brackets. It makes sure you only pay your regular Australian tax. But no scenario ever pays double tax. At worst, you pay the higher of the 2 rates split between the US and Australia. Does investing in ETFs differ from investing in individual stocks, you may ask? Whether you invest in US shares directly or indirectly through ETFs or managed funds, the tax dynamics remain largely the same. If you buy US shares or US-listed ETFs, for example, on a platform such as Parallel or Stake, you will submit a W8 and have 15% withheld on any dividends those investments pay. You then declare the dividends in Australia and claim the 15% FITO. If you invest in an Australian domicile ETF or managed fund that holds US shares, for example, an ASX-listed ETF like IVV or VGS, which owns US stocks, that fund will handle the foreign tax for you. Typically, the fund will receive US dividends net of 15% withholding tax, then distribute the income to you. In the annual tax statement from the fund, you will see foreign income and foreign tax paid on your behalf. You can then claim the foreign tax offset similarly on your tax return. That means you still effectively got the tax 15% by the US, and you get to use that credit against your Aussie tax proportionally. One minor consideration, make sure to include the foreign income grossed up and foreign tax credit when you do your tax return. Don't just declare the cash distribution, you need to add back the foreign tax to claim the offset. Sometimes filing this foreign tax income and offset can be messy if you do it manually. That's why I personally use Navixa, my go-to portfolio management app that saves me hours every tax season. Not only it can automatically import every trade and dividends across all my brokers, all I need to do is cross-check and confirm the pre-filled grossed up dividends and foreign tax withheld, which will be put into a neat tax report. It also gives me real-time performance metrics, alerts on dividend dates, and beautiful charts to track my asset allocation, all in one place. I used to spend hours on my DIY Google Sheet. Now Navixa does it for me, saving me heaps of time. If you like to simplify your investing life and your tax return, check out Navixa, and if you use my link to sign up, you will get 25% discount on yearly subscription. So in short, there's no tax avoidance advantage in choosing an ETF versus direct shares about US tax withholding. Either way, Uncle Sam takes his 15% cut of dividends, and you then rely on the FITO to get the credit for it. Now, remember that we mentioned earlier that whether the foreign income tax offset can entirely eliminate the US tax depends on 2 things. One is your tax marginal rate, and the second is the FITO limit. Now let's talk about the FITO limit. If your total FITO claim is $1,000 or less, you record the foreign tax paid, no questions asked. However, if you pay more than $1,000 of foreign tax, which by the way, can include taxes from other countries, not just the US, you need to calculate your offset limit based on your overall tax liability. Here is the 3-step simple way. I called it homebrew method. Step 1. Calculate your total Australian tax bill. Say by June 2025, Sarah has paid $3,400 in total in foreign income tax, which is well above $1,000. Her total taxable income was $31,130, so her tax would be $3,079.30 to the ATO. Step 2. Recompute tax without your foreign source income. If she pretends she never received that foreign income and ignores related deductions, recalculate the tax on just her domestic income, which would be $19,830, tax at $309.70. Step 3. Your FITO limit equals Step 1 minus Step 2. The difference between those two tax figures is the maximum foreign tax Sarah can offset, which is $2,769.60. Even though she paid $3,400 overseas, her offset is capped at $2,769.60. The extra $630.40 is lost. Suppose all your foreign income is from a US dividend, which is cut by 15%, or you can think of this 15% as your average foreign tax rate. In that case, we can oversimplify and work out the cross point that if your total US gross dividend for the year is less than $6,667, you can fully eliminate the tax by the FITO. But if your US dividends exceed $6,667, then your foreign tax paid would exceed $1,000. And then you must switch to the 3-step cap method we just ran through to determine precisely how much FITO you can claim. And put simply, once your US dividends go above that number for the year, you'll start losing some of that foreign tax credit. Finally, while this particular US revenge tax threat has passed, is a reminder that tax laws can change suddenly. And staying informed, knowing your tax position, and filing the correct forms are super critical. That said, don't let tax minimization be your only reason to invest. That's like a business owner saying, in order not to pay big tax, I better not to make my business profitable. Your foreign investments do generate real returns, and that's the point. Now, tell me, what is the trickiest part of doing your own FITO? And thanks for hanging out. See you in the next one. Bye.